InMode stock is down 40% in the last month, and in this video, I am going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and use my Excel spreadsheet to determine InMode's intrinsic value. First of all, this is a very small business with only a $1.7 billion market cap. It's a company based in Israel, specializing in laser machinery for cosmetic medicine. Therefore, they are in the beauty sector. If we take a look at the financials, they grew a lot during COVID, and that revenue percentage has naturally come down. They have been growing between 20 and 30% over the last couple of years, and analysts have them growing between 15 and 20% for the next 3 years. Moreover, they reported earnings on October 12th, and they lowered future guidance regarding revenue. In conclusion, revenue percentage growth is decreasing, but they still have growth. They are also growing net income and free cash flow. Net income growing from 22 million in 2019 to 182 currently. Similarly, their free cash flow went from 36 million to 175 currently. This is due to their high margins. Their gross margin has consistently been between 83 and 87% over the last years, which is insane. Just to put it into perspective, Microsoft, a very high margin business, has 68%. Their free cash flow margin is 28% and profit margin 34%. And regarding profit, analysts are expecting this company to make $3.50 in 2025. If you assign a 15p to the company, which is low, it would make it a $53 stock. This is 155% upside potential in 3 years, which is insane. But keep in mind that there are only 8 analysts covering this company. So far, the financials look very good. But the question becomes, can we pay a good price in order to make a good return on our money? In order to answer this question, we are going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis and did low, middle, and high assumptions. Right now, you are seeing 6 numbers. The top 3 are based on net income and the bottom 3 on free cash flow. These numbers mean 2 things. First, that in order to make the desired annual return that I have put in, you need to pay these prices. Second, that if the low assumptions occur, you're going to make a 21% annual return on your money. If the middle assumptions occur, 33%, and if the high assumptions occur, 46%. This means that if the middle assumptions occur, you could get a multi-bagger in less than 20 years, which means that a $10,000 investment becomes $1 million. And I think my middle assumptions are reasonable. As I have the company growing at 15% annually, keep in mind that analysts are expecting between 15 and 20, with 28% profit margin, it is currently 34%, 28% free cash flow margin, which is currently at 28%, and assigning a 20 PE and price to free cash flow to the company. The Excel spreadsheet does not address any value to the balance sheet, and this company has a perfect balance sheet with only $3 million in debt and $600 million in cash. So they essentially have 0 debt, which is amazing. However, there are also some risks involved with this company. The ones that I have found are the following. Their headquarters are in Israel, and obviously there is a war going on in Israel at the moment. However, they are present in 71 countries, and less than 1% of their revenue comes from Israel. Moreover, they recently said that production was fine. The second risk is that this is a very small company. On the other hand, this could mean a lot of upside potential, as they could have a long runway. The last con that I have found is that revenue is decreasing, and if we get into a recession, there could be less demand for their products. On the other hand, this is a company with a perfect balance sheet that still has revenue growth and with insane margins. Most importantly, their valuation is very attractive, as we have seen on the Excel spreadsheet, and they are trading at a forward PE of 7. For these reasons, I bought the stock, but remember that this is not financial advice and you should do your own research. I hope you enjoyed the analysis. Let me know what you think about the company in the comments, and I'll see you on the next one.